Good afternoon, investors. Welcome to the Brick by Brick Next Level REIT Investing, where we'll build on the basics covered in the previous webinar and get into the advanced REIT analysis. But just a reminder to all our participants, before we begin, please keep your microphones muted during the entire session. If you do have any questions, feel free to use the chat box or the comment section, and we'll address them during the Q&A segment. So my name is Frank Fernandez, Dragonfly's research analyst. I'm thrilled to be here with you all and to share some insights on improving your REIT analysis. So without further ado, let's get into it. Okay, so before we get into the advanced metrics and how to value a REIT, I'll give a quick recap of what we covered in the first part of this two-part webinar series. In the last webinar series, we talked about what REITs are and how they work. Next slide. In essence, REITs are companies that own, operate, and finance income-generating assets. They are publicly listed in the PSE and trade like regular stocks, so meaning you can buy and sell their shares, owning a fraction of the REIT. And the best thing about the REIT is that it is required by law to distribute at least 90% of its distributable income to investors. Now, there are two ways a REIT can grow. The first one is through organic growth, which refers to the growth for REIT's revenue and profitability through internal improvements and enhancements to existing properties like rent escalation or upgrading building facilities. The second one is inorganic growth, which involves expanding a REIT's portfolio and income through acquisitions and mergers like a property for share swap deal. Now, also in the last webinar, we covered 5 important metrics that every REIT investor should know. The first one is distributable income, which is a portion of an income available to be distributed to shareholders. The second one is GLA, which refers to the total floor area or leasable space that can be rented out. The third one is the occupancy rate. It's the percentage of a property's GLA that is currently rented out. The fourth one is the weighted average lease expiry, which measures the average time left the lease of a property expires. Finally, there's also rent escalation. It's simply the periodic increase in rent. On the next slide, we have a table that summarizes all of these metrics. So they're updated as of December 31, 2023, but I know that the Q1 earnings of all the REITs are out. So although I don't think that there's a lot of significant changes to it. Also, we can expect the portfolio and GLA of A-REIT, RCR, and M-REIT to increase by the end of 2024 as they are set to acquire additional properties through property for share swap agreements. Okay, now it's time to move on to the main topic of this webinar. Now, let's start with the advanced metrics that will help us later when we talk about valuing a REIT. So the first one is called net operating income, or NOI for short, which captures a REIT's profitability before depreciation, selling, general, and administrative expenses, or SG&A, interest, taxes, and capital expenditures, or CapEx. Essentially, it excludes non-operating income and expenses. It's calculated by deducting the direct real estate expenses from the total revenue. It's somewhat similar to a gross profit, except that gross profit is revenue minus cost of goods sold or services sold. It's focused on direct costs associated with producing goods and services, and it's normally used in the manufacturing and retail sectors. Net operating income, or NOI, on the other hand, is commonly used for REITs since it focuses on costs associated with running its income-generating properties. So this is an important metric because it's used for valuation. It's one of the 2 important variables used to estimate the fair market value for REITs income-generating properties. The second one we'll get to in a bit. It also focuses on income generated from operations, giving you a clear picture of a REIT's core operations. On the next slide, I have an example of how to calculate that. So using A-REIT's 2023 income statement taken from its annual report, we would only need to take its revenue of 7.14 billion and direct operating expenses of 1.98 billion. So once we have this, we can easily get net operating income. All we have to do is subtract the direct, next slide, please. Okay, so here, once we have those two figures, all we have to do is deduct direct operating expense from total revenue, and that will give you an NOI of 5.16 billion for 2023. Thankfully, because A-REIT is probably the most followed REIT and is very detailed with their disclosures, you can actually find their NOI from their supplemental performance reports. You can download it from their websites. For most other REITs, you would have to calculate yourself because I don't think that they provide it in their reports. Next, we have a metric called the capitalization rate, or cap rate for short, which is used to evaluate the return of an income-generating property based on the income it generates. So the cap rate is often likened to like return on investment of a investment, but the cap rate solely focuses on the property's income relative to its value. You can easily get it by dividing NOI by the property value, or you can get the sector's cap rate from Colliers, which is a globally recognized professional services and investment management company that provides detailed research about our very own real estate market. So if ever you can't calculate the cap rate, you can always refer to Colliers' report for the industry or sector cap rates. So this metric allows investors to determine the return on investment of a specific property and draw comparisons between different properties. But also remember that the higher the cap rate, the greater the risk and return. Next slide. On the next slide, I do have an example of this. So using A-REIT again, the value of A-REIT's portfolio is about 81.23 billion. You can find the value of each of its properties in its annual report. And the NOI we computed earlier of 5.16 billion. So if we divide 5.16 billion by 81.25 billion, we would get a cap rate of 6.35%. So a cap rate of 6.35% essentially means that the properties of A-REIT's portfolio are expected to return on average 6.35% of their value in net operating income annually. But you can also use the cap rate of the sector to value a REIT. So there's a screenshot on the screen that shows you the Colliers Q4 2023 cap rate. So the office sector has a cap rate between 5 to 6%. The retail sector has a cap rate between 7 to 8%. And the industrial sector has a cap rate of 8 to 10%. Now for the next metric, we have something called funds from operations, or FFO for short, which is a measure commonly used by REITs. You won't necessarily it was developed specifically for REITs, and you shouldn't use it for other industries, I guess, yeah, because it is used to define cash generated by their operation, by REIT's operation. It's calculated by adding back depreciation, amortization to net income, and subtracting any gains on the sale of properties, or adding back losses on the sale of properties. So the purpose of FFO, or funds from operation, is to measure the financial performance or operational performance of a REIT by providing a more accurate gauge of its operating performance than net income. So due to the exclusion of non-cash items like depreciation and amortization, FFO can also be used to compare REITs by removing the impact of the different accounting methods that they would use, making it easier to evaluate their operating efficiency and cash generating capabilities. So on the next slide, I have an example. So using C-REIT, this is from their 2023 investors presentation. We can calculate FFO. So on the table, it already shows something called adjusted funds from operations, but for now, we'll ignore it. So to get funds from operation, we would need its net income for for example, the fourth quarter, which is 380 million. And then we add back depreciation of 17.81 million. Thankfully, our C-REIT doesn't have any gain on sale or loss on sale, so we'll leave that as zero. So now that we add it back, we arrive at an FFO of 397.78 million. Yeah. And then on the next slide. So on the next slide, sometimes REITs have fair value changes in investment properties, and that's something we have to adjust for also. So since it's a non-cash item and income not generated by its properties, we do have to adjust for it. So for example, a REIT had a fair value change investment worth 200 million. So it added back 200 million in its income statement. To adjust for that, we'd have to subtract it. So that equals to an FFO of 4.83 billion pesos. Next, we have adjusted funds from operations, or AFFO, which is an enhanced measure used by REITs to define cash generated by their operations after accounting for recurring capital expenditures and adjustments. It's calculated by taking FFO and subtracting recurring CapEx and other adjustments like straight line rent adjustments to reflect a more accurate measure of cash generated. So AFFO provides an even more accurate measure of its operational performance because it accounts for maintenance costs required to keep the properties going. This metric offers investors a clear view of how much cash available for distribution to shareholders there is, and can be also used to compare with other REITs to see which one is more profitable. On the next slide, using C-REIT again, we will compute for AFFO. Since we already have FFO from the previous slide, all we have to do is subtract CapEx and straight line adjustment. So C-REIT doesn't seem to have any CapEx. So it's just straight line adjustments. And with that, we can get AFFO easily. So subtract straight line rent adjustments and we arrive at 351 million, which is the exact amount shown on the investor presentation or the table on the screen. Now, if you look closely, you'll notice that the amount of dividends distributed is 100% of its AFFO. This is a reason why C-REIT can distribute 106% of its distributable income, because its AFFO provides a more accurate measure of cash, which matches the amount distributed as dividends to shareholders. So that's why it can do that, because AFFO is the exact, their dividends is the exact amount of their AFFO. Yeah. But they do have their drawbacks. So FFO and AFFO are non-GAAP or PFRS measures or metrics, meaning that they're not governed by the same accounting rules as, let's say, gross profit, or they're not standardized. They were created by the National Association of REITs, or NAREIT for short, specifically for REITs to provide a better measure of their operational profit. But because of that, there's no standard way of computing FFO or AFFO, which is why earlier when with a REIT, it had to add back its fair value changes to investment properties. So that leads to varied calculation methods, like like what I mentioned earlier. All right, now that's all the metrics that we'll be covering tonight. We can finally move on to how to value a REIT using something called the net asset value model, or NAV model for short. To start, we would need to know how to forecast a REIT's revenue. So the first thing we'd have to do is learn how to forecast its rental income. And the approach I'll be using for this one is something called the occupancy rate and rent per square meter approach. So essentially, it breaks down rental income growth into two drivers, one with occupancy rate and growth in rental income per square meter. What we need to do here is calculate the historical rent per square meter and grow it by the assumed rent escalation per year. So here we're using rent escalation as the growth rate assumption because management or the REIT company has provided information how much they increase their rent every year. So that is an accurate assumption that we can use to measure how much their rent will grow every year. So the formula for historical rent per square meter is rental income for a 1-year period over the GLA over occupancy rate. So just have to divide rental income by GLA and then by occupancy rate. The next one is the future rent per square meter. And the formula for that is historical rent per square meter times 1 plus the rent escalation, which is, this formula is actually just the future value formula. So future value equals present value times 1 plus the growth rate. So another thing to remember also when it comes to forecasting is the phrase called garbage in, garbage out, which essentially just means that the quality of your forecast is dependent on good in management disclosures, reasonable assumptions for occupancy rate, and rent increases. So it's basically like in with the new, out with the old assumptions, something like that. On the next slide, I have an example of how to calculate that. So on this day, so when you start, you would need to get the historical GLA per square meters, the occupancy rate, and the rental income. So this is for A-REIT. So for 2022 and 2023, we have that data available. So it's shown there. So, and to keep things simple for this model, we'll just assume that for 2024 and 2025, the GLA and occupancy rate remains stable. Now, and then for the growth rate, we have the rent escalation. So for 2024 and 2025, we'll use the median average growth rate, rent escalation of A-REIT, which is between 2.5 to 5% per annum based on some of their release agreements. So we'll get the median, which is 3.8. So yeah, we have to fill in those blanks. So using the formulas below, so for the first formula, so annual rent per square meter or rental income over GLA over occupancy rate is used to calculate the annual rent per square meter for 2022 and 2023. And then for monthly rent, it's simple. We just get the annual rent per square meter and divide that by 12. And then once we have those figures, we have to grow the monthly rent or the annual rent per square meter by the growth rate or rent escalation. And once we've done that, we can finally compute the rental income for 2024 and 2025, which is simply the annual rent times GLA times occupancy rate. So on the next slide, we'll see a completed table. And there you go. So you guys compute this for yourselves just to make sure, but essentially this is what you will need to forecast rental income of a REIT. Next slide, please. Now that we have that, we have to also think about forecasting total revenue, because that's another important factor that we need to compute for NOI. So rental income is just one part of the total revenue. So it has dues, which is basically expenses charged back to tenants for common area uses or utilities. And then we also have interest income from finance leases. So just to keep things simple, I used here is that the assumption I used here is that the dues and the interest income from finance leases are a percentage of rental income. So essentially, I divided dues by rental income and divided interest from finance lease by rental income to arrive at the percentages you see below. So for example, 1.25 billion over divided by 5.44 billion would give you 23%. And then I would got the average of the two percentages of 24.4 and 27.4% and 23%. And that would give you an average of 25.2%. And then I did the same again for interest income from finance lease, which would give me an average of 7.1%. So those are the assumptions I used. But the same approach used to forecast rental income can be used also to forecast dues and dues per square meter. But just to keep things simple, this is the method we'll be using. So once you've done that, to get the amounts for 2024 and 2025, all you have to do is multiply the rental income of 2024 times the 25.2%, and that will give you 1.42 billion. And the same goes for interest income from finance lease, which is rental income times the percentage of 7.1%. So from there, all you have to do now is just add the values and you would arrive at your forecasted total revenue for a REIT. Next slide, please. Next, we will have to learn how to forecast direct real estate expenses. So the approach here is similar to the one I just discussed now. So it's called the occupancy rate and direct cost per square meter approach. Next slide, please. Yeah, so it's essentially the same, except that we're switching out rental income with direct costs. So here we break down direct cost growth into two drivers, so occupancy rate and growth in direct cost per square meter. For our assumptions here, we have to assume an expense growth based on, let's say, an historical average, management guidance, or maybe even inflation. We need to calculate the historical cost per direct cost per square meter and grow it by our growth assumption per year. The formula for that is historical direct cost per square meter equals direct cost over GLA over occupancy rate. And also for future cost per square meter, it's also historical direct cost per square meter times 1 plus the growth rate. Next slide, please. Okay, so here, like forecasting rental income, we would need GLA, occupancy rate, and now we would need direct cost. So following the same assumptions, we would keep the GLA and occupancy rate the same for 2024, 2025. Now with that, all we have to do is fill in the blanks. And also for the growth rate, here I'm using the BSP risk-adjusted inflation. So for 2024, the risk-adjusted inflation is 4%, and for 2025, it's 3.5%. Just an easier, a reasonable assumption for the increase in costs, in prices. So now we have to fill in the blanks. So for annual direct cost per square meter, we would use the formula annual direct cost per square meter equals direct cost over GLA over occupancy rate. And then for the monthly direct cost per square meter, we just have to divide that by 12. And then for the future direct cost per square meter, so we'll apply the future value formula, which is basically historical annual growth per square meter times one plus the growth rate, or in this case, inflation. And then once we have those, we can finally get direct costs, which is future direct cost equals annual direct cost per square meter times GLA times the occupancy rate. Next slide, please. Water break. Now in this table, we have the completed calculations. So with that, we arrived at like an annual direct cost for 2023 of 2,220 pesos per square meter, or a monthly direct cost per square meter of 185 pesos per square meter. So with that, we have finished forecasting the variables needed to compute for NOI. Okay, next slide, please. Okay, so now that we've done that, we can move on to finding the fair market value of a REIT's income generating properties. Next slide, please. Okay, so for this one, we'd have to take the net operating income generated from the portfolio of properties on a 1-year forward basis. So that means the net operating income from 2024 and divide it by the cap rate. So NOI over cap rate. But important reminders is that the cap rate is the most important assumption in our net asset value model, because if you use because it's solely dependent on acquiring the fair market value of a REIT. It's not about forecasting what the future cash flow like in a discounted cash flow model. We want to use the most accurate measure to get the value of a property now. So another important thing to remember is that the higher the cap rate, the lower the fair market value, and the lower the cap rate, the higher the fair market value of its income generating properties. Next slide. So for this example, I'm still using a REIT. So since we forecasted the rental income and direct cost for 2024, which was shown in the previous slides, we can now get the NOI, or net operating income, for 2024, which equates to 5.41 billion pesos. And for the cap rate, this is I'm using 6% which is taken from Collier's report on office sector. So for the office sector, 6%. This is just for this example. And so with that, we've arrived at a fair market value of its income generating properties. So it's worth 90 billion pesos. Next slide, please. Okay, now it's time to tie everything together using the net asset value model. So the next slide. So this is the probably a very, very common REIT valuation approach. It's a model used to determine the value for REIT by assessing the market value of its income generating the present. Hello. Okay. So again, we will now tie everything together using the net asset value model. So this one is probably the most common REIT valuation approach. It's a model used to determine the value for REIT by assessing the market value of its income generating properties. So rather than estimating future cash flow and discounting them to the future, discounting them to the present, sorry, like a discounted cash flow model. We use it to determine whether or not a REIT is undervalued or overvalued. So a rule of thumb here is to always aim for a 15 or 20% upside. So that way you can expect some reasonable gains. So the formula for computing net asset value is the fair market value of its net income generating properties plus non-real estate assets minus the total liabilities. Next slide, please. So why the net asset value model over discounted cash flow model? So for one, REITs are asset heavy. REITs are primarily valued based on their real estate properties. The NAV model directly reflects the market value of those properties. The other one is market transparency. The real estate market tends to be relatively more liquid than the other assets you'd find in other companies and are more transparent, providing more reliable prices for properties. Excuse me. This makes it easier to assess the fair market value for REITs assets and provides reliable market prices and cap rates for each segment. So for companies in like the technology, retail, or industrial sector, asset values on their balance sheets lack efficient markets. Therefore, valuation methods like the DCF would focus more on cash flow or income approaches in order to derive their value. While for REITs, REIT valuations benefit from, like I said, more relatively liquid markets, and they provide a clear insight into the fair market value of their assets. So the NAV model, I'd say, is more preferred for REITs as it relies on real estate market prices to determine its value. The other one is it's simple and I guess more reliable. The NAV model is easier to do, simpler and more straightforward than the DCF. It also avoids a lot more subjective assumptions when projecting future cash flow. And again, the NAV model heavily relies on observable market data like property values and cap rates to derive its value, reducing the reliance on other projections or assumptions. Next slide. Okay, so now this is what you would expect to see for your NAV model. So fair market value of its income generating properties plus the non-real estate assets. So 90 billion plus the 16 billion, which is taken from our own model. So that gives you a market value of assets of 106 billion. And then we have to subtract the value or the total liabilities, which for our forecast, our projection is 10.5 billion. And that would give you a NAV of 95.65 billion pesos. And now for this is AREIT's NAV model. So AREIT has 2.4 billion outstanding shares. And now we have to divide the net asset value by its outstanding shares. So for 2023, an historical period, we'd arrive at a NAV per share of 38.5 pesos per share. while for 2024, the target would be 40.4 pesos per share, which is a discount of 19% from the market price of 33.9%. So the NAV model that we arrived for a REIT of 40.4 pesos per share is actually pretty close to the Bloomberg consensus target of 41 pesos and below the average target found online of 43 pesos. So when it comes to forecasting, it's better to be more conservative than aggressive because you don't want to overestimate your investment decision or your thesis, because we want to manage expectations and manage risk. So it's better to be conservative than to be aggressive when you model the value of any REIT or company. Next slide. So another important thing to remember is that when you do a NAV, a net asset value model, or a DCF model, you would need to also learn how to do what's called a three-statement model. So with a three-statement model, you'd be able to get the value of its total assets, liabilities, and equity. So it's key framework in financial modeling because it integrates the income statement, the balance sheet, and the cash flow statements together, giving you a more holistic view of the company's performance. It involves forecasting a company's future financial performance, estimating the values of its three financial statements. So you'd have to forecast its total assets, its future debt, its revenue, and its other expenses like interest, and other you'd also have to forecast receivables, payables, PPE, property, plant and equipment, intangible assets, and such. Basically, anything found in their income statement would have to be forecasted in their three-statement model. But that may sound intimidating, but there's no need to worry because there are so many articles online and videos online that would easily teach you this. And we also have in Dragonfly what we call Dragonfly roadmaps. So here, if you go to your investor's corner, you will be able to find the Dragonfly roadmap, will give you a quick, very detailed overview of fundamental analysis, technical analysis, and investing. For fundamental analysis, it will teach you what fundamental analysis is and the difference and importance and how to analyze each of the key financial statements like the balance sheet, income statement, and cash flow statement. So everything you would need to know to get started, you can find in our Dragonfly roadmap. All right. So that ends this webinar on advanced REIT analysis on how to value a REIT using the net asset value model. So just for everyone to build on what we've just learned here, all Dragonfly account holders will receive our exclusive weekly newsletters packed with the latest news, investment updates, and expert insights. You'd also have access to our research reports and our very new Dragonfly roadmap. So if you haven't joined already, we encourage you to download the app and create an account today. And so you never miss out on our webinars, our research, and our trade alerts for those who follow our investing club. So let's get started with the Q&A section. Let's have the first question. So so the first question is, how can I use the NAV model to make investment decisions? So you can compare once you've done the net asset value model and arrived at the NAV per share, you can use that you can compare that with the market price to determine whether a REIT is undervalued. So if the market price is below the NAV per share, that's undervalued, or if it's overvalued, meaning that the market price is above the NAV per share. Another thing is that with this, you would have to combine it with technical analysis. Because this will help you better determine an entry point, because you would already have a fundamental reason to buy a REIT. All you would need now is a good trading plan. And always remember to aim for a 50 to 25% upside or a discount to NAV. The next question is, how do changes in a REIT's property value or GLA affect its net asset value? So an increase in the property's value will raise its total asset value, thereby increasing its net asset value, while a decrease in the property value will lower its net asset value. And for GLA, an increase will lead to an increase in GLA would definitely lead to an increase in net operating income due to the more leasable space generating rental income, which is also which would also lead to an enhancement on the value of its properties. Next slide. Next question. So why do REITs use distributable income rather than AFFO to determine its dividends? For this one, because distributable income is defined and mandated by the REIT law, ensuring a standardized approach for REITs. Because as mentioned earlier, AFFO and FFO is not standardized or governed by any accounting principles. For example, the distributable income of a REIT, RCR, and MREIT, they do not add back depreciation, amortization, or any CapEx expenses. It only normally accounts for fair value changes in investment properties, straight line adjustments, and lease commissions. Yeah. Next question. Okay, how does the possible oversupply and rising vacancies in the Philippines affect the cap rates? Yeah, okay. So the oversupply of leasable space arising from the vacancies and rising vacancy, would definitely lead to higher cap rates. This is because the decrease because of an oversupply and rising vacancies, that would lead to a decrease in net operating income because of lower rental rates and higher vacancies. So combined with an increased perception of risk, that would definitely lead to a higher cap rate. And then a higher cap rate also reflects investors' demand for greater compensation for the added risk associated with the lower income potential in its current market conditions. Next question. What percentage of one's portfolio is allocated to REITs? Okay, so any investor, especially if you're young, would have equities of, I guess, 80% and 20% like bonds. That's just an example. So based on that 80% of REITs, if 80% of equities, if you're a dividend investor, REITs is definitely a good investment. REITs are definitely a good investment for dividends. So you would allocate a larger portion to REITs, but you don't want to over allocate yourself in every REIT. You want to buy specific REITs. Like, I guess the most popular ones now are, based on what I've seen, is like A REIT, RCR, M REIT, and even sometimes yeah. So I would say never over allocate more than 20% on any one REIT or stock. You want to keep it balanced. Let's say, I guess, normally for me personally, I always keep it under max of 15%. So every time I would add, I would readjust and invest in order to make sure that my investments would hit 15%. But you don't have to do this all the time. It really depends on how much capital you can invest and deploy on each REIT investment. So yeah, just don't over allocate in all the REITs. Pick the winners, pick the good ones, the ones that are growing, and never allocate more than 20% in any one stock. Or yeah. Next question. What benefits do REITs bring to their own sponsor companies and vice versa? Like the benefit of A REIT to ALI and RCR to RLC. Okay, so the great thing about this is that a lot of these REITs are doing a lot of these sponsors and REIT platforms are all doing property for share swap agreements. I guess that one reason is because of the high interest rate environment. But because of that, so the benefit for the REITs is that they get additional properties. For the sponsor, they get to offload, I guess, fully depreciated properties or very mature buildings to their REIT platform and raising more capital to invest in other developments. So, for example, the property for share swap agreement between RCR and RLC. So RLC will receive, I guess, like almost 5 billion common shares at value of 6.8 pesos or 33 billion pesos. So with that, later on, RLC has the capacity to raise funds by selling shares if they choose to, and developing other properties, or if the REIT platform acquires with cash properties from their sponsor, and then that way they can easily develop more buildings, residential, commercial places. Yeah. Next question, please. Where can we get info for cap rates? So for sector cap rates or industry cap rates, the one I've always referred to is Colliers because they're a reliable source. You can also check if you have access to Bloomberg or Reuters. Other than that, you can compute the cap rate yourself by getting the net operating income divided by the property value of its portfolio. So you can easily get the historical cap rates of any REIT by checking their annual report. And then if ever you want to get the cap rate for the forward 2024, 2025, I suppose one way is to get the historical average of those cap rate, or you get the industry average by computing every REIT's cap rate, historical cap rate, or you can forecast and value the properties of each REIT and then divide it and then get the NOI and divide it by the forecasted value of properties. But if you don't want to do all those calculations, Colliers reports are a good way to start. So you have to search, for example, Colliers cap rates 2023 or 2024 if they have Q1 already. Yeah. Let's go to the next question. Do you think that after decades, REITs are still in the stock? Yes, I think that REITs are here to stay. They are such a profitable investment vehicle and very great for dividend investors. Yeah, I think they're going to be here for a very, very long time until, for some reason, the stock market closes. Okay, let's see if there are any more questions. Okay, just to clarify, the 20% allocation for REITs is applicable to just one REIT stock or all your REIT stocks? No, the 20%, it depends on how many stocks you want. Ideally, you want 8 to 10. So if that's the case, then you don't want to allocate more than 20% on one REIT stock. But with that said, that doesn't mean you can buy all the REITs, because that means you'll be over allocated in every single you'll be over allocated and very exposed to property sector risk. Do you believe that Phil REIT has the potential to recover, and will you view it as an undervalued company for now? So yeah, because of the high interest rate environment, a lot of these REITs tend to be undervalued because, one, they're not going through a lot of growth. They can't finance their acquisitions through debt yet because yeah, the interest rate's so high. And for Phil REIT, that depends if they can actually execute their growth plans. So right now they're looking to expand on their sustainability themed offices. And I guess a good way to improve is, if one, for starters, if they can get a higher occupancy rate, and then if they can expand outside of Alabang and Cebu, um, because a lot of the REITs, a lot of the other REITs, office REITs like RCR or MREIT, a lot of their buildings are in key business districts like BGC, Ortigas, and then you also have some in like Manila, Mandaluyong, Quezon. So they do have a big reach in metro in Manila, and that helps them um, helps them have that competitive advantage over any other REIT. So I would say, if you're considering office REIT, you would right now, for now, go for the better one, the bigger ones, the ones with more with a higher occupancy rate, with more exposure to other um, densely populated cities and regional hubs. Yeah, you're welcome. We worked hard for that. We were mental technical analysis. So yeah, for those who don't know about it, please look into it. Check the investing corner to find our Dragonfly roadmap. Sorry, hold on. All right, let's see if there are any other questions. That looks, I guess that's it for now. So that's all the time we have for questions. Um, Thank you for everyone that sent their questions. And that would end our webinar series on brick by brick, next level investing. So thank you all for joining. We hope that this series has been valuable to your investing journey. So if you have other questions, please send them to investingclub@dragonfly.ph, and we'll get to them as soon as possible. So that concludes our webinar. Thank you so much for joining, and have a great weekend.